My name is Mark Bowd. I am the Senior Vice President and Chief Economist of MetroStudy. I'm here to share with you the most recent findings of the national edition of the Residential Economic Report. At the foundation of this report are modeled forecasts associated with the supply and demand and over or undervaluation of housing. Overall job growth during the first part of third quarter 2017 was quite healthy on a national basis until the last part, wherein we experienced storm-ravaged areas of Texas and Florida have slowed employment growth and caused losses during the latter part of the third quarter. These particular charts show the trends and forecasts associated with residential permits and housing supply. We expect overall permit activity to continue to increase at a controlled rate, followed by increases of supply which will likely peak during year 2020. These forecasts of housing supply originate from our construction starts forecasts, which are likely to peak during year 2020 at a level slightly short of 1.5 million housing starts. Overall mortgage rates have remained surprisingly low during the past quarter, hovering around 4% fixed for a 30-year mortgage. We still anticipate mortgage rates to climb slowly during the next 3 years, though we've tempered our forecast from that which was set forth during second quarter of 2017. Our forecasts in fixed mortgage rates follow the inflation forecast set forth by the U.S. Department of Labor. The U.S. Department of Labor forecasts 2.5% inflation during year 2017, which may prove aggressive given that the rate during third quarter was closer to 1.4%. Our forecast for price appreciation slows during the next few years as we approach the overall ceiling of price potential on a national basis. Flat wages, which have been recorded during the past several quarters, don't necessarily present the entire picture associated with household income growth. We feel that the growth in household income is higher than that reflected by wages and salaries due to augmented incomes associated with second and third jobs. Far more of our working population is participating in secondary income generation associated with jobs generated by Lyft, Uber, and other secondary sources. All of this information is presented in generating our most recent version of our housing model. The left chart reflects overall supply and demand of housing, with the blue line reflecting supply while the green line reflects overall housing demand. The chart on the right reflects the difference between these two curves, identifying periods from 1990 forward where the cycle has experienced oversupply and periods of undersupply. During the most recent period of third quarter 2017, we estimate 1.7 million houses in terms of overall shortages, which translates to about a 1.2% shortage of housing throughout the nation. This level of undersupply is likely to continue to mount to a high level recorded in year 2020 before receding back toward equilibrium. The second half of the model reflects valuation patterns. On the chart on the left, the green line reflects where we think overall prices should be based upon economic, socioeconomic, and demographic fundamentals, while the blue line reflects overall median prices of housing from 1990 through our 5-year forecast. The chart on the right reflects the overall differences between where prices are relative to where we think they should be, identifying areas of overvaluation and undervaluation. For year 2017, the national housing market has just entered into a mild period of overvaluation, though these levels of overvaluation are likely to grow during the next 3 years due to continued housing demand pressures. Both parts of this model are shown numerically in the Residential Market Opportunity Risk Index. This index is a weighted index of over-underbuilding and over-undervaluation that effectively forecasts market conditions for the next 24 months. During year 2017 and 2018, the market is likely to experience stable ground with stable indexes that reflect healthy conditions through year 2020. Thereafter, however, overall market conditions will weaken and risks associated with home purchase and land acquisition increase. National market conditions don't necessarily reflect overall potential for various regions throughout the nation. In this particular chart, the top 10 markets are listed based upon risk factors associated with over or underbuilding and over or undervaluation. Based upon these risk factors, the overall risk associated with these markets and most other markets we track throughout the United States represent far lower risk than they did in year 2006. Key takeaways for third quarter 2017 include a national housing market that is already significantly undersupplied and will become more so through year 2020. The national housing market is heading toward overvaluation, and some markets are already overvalued. Still, the national housing values are nowhere near the levels of risk and overvaluation that prevailed during year 2005 and 2006. The surge in remodeling and renovation market activity will continue in the near term, partly due to the relative lack of new home supply. In the longer term, rising mortgage rates may force many would-be home buyers to renovate instead of purchase. The window of land purchase and land development remains open through year 2019 in most markets. It's longer in some markets and shorter in others. And finally, rising mortgage rates have yet to appear, but inflationary pressures are slowly building. Eventual rising mortgage rates may contribute to severe overvaluation in many markets, despite only modest price appreciation during the next few years. Still, we've recently tempered our forecast in mortgage rate increases due to reduced inflationary concerns during the current year. The Residential Economic Report presents these modeled forecasts for every metropolitan area throughout the nation. For more information, visit metrostudy.com.